What is up, traders? Welcome back to our YouTube channel and the free futures course that we're breaking down. Today we're going to learn everything that you need to know about market movement, what really moves the markets, how to read market direction, understanding stop hunts, creating daily bias, and understanding movement on any given day at any given time. So we're going to leave the confusion out of this. We're going to break things down step by step and understand who is really in control and how you can avoid getting stopped out continuously. So let's break this down. Let's dive into this intro and dive right into lesson number 2. So this is the second lesson of the futures day trading course here on YouTube. I've split it up into 2 parts, so you're not watching one individual lesson for like 30-40 minutes. So this one's going to be a bit shorter, then we're going to do another one that continues on with market movement. But first, the basics of market movement. We're going to start off with some understanding of how markets move just based on price action, and then we're going to wrap things up by the end of this video looking at the premise of auction market theory. And then the second video, we're going to be doing a deeper dive on auction market theory and market movement. So let's dive right into this one. So market movement is one of the most sought after skills in the market. Understand what's going on and you're a millionaire, right? That's what everyone preaches. Price action, ICT, this and that, right? Stop hunts, auction market theory, order flow. Everyone has the secret. But realistically, there's no one right answer. I'm going to show you the easiest way that I look at the market based on the understanding of market participants and volume. So we're going to be breaking market movement down from A to Z, starting with the simple concept of trends, right? Price action, stop placement, and where institutional trader psychology comes into play to actually create some kind of stop placement moves and aggressive buying or selling. Right? All of this is going to start pulling us into auction market theory eventually, where these concepts translate very seamlessly, as you'll see by the end of this video. So we want to understand how to read price movement through the only tool that actually moves the market, right? We want to understand volume. Volume comes from heavy-handed market participants and their psychology in terms of actual order placement and stop placement. First things first, what kind of charts are we looking at? Because everyone talks about different types of trends, market movement, price action, market structure from the perspective of multi-minute charts, right? 10, 15, 24-hour, blah, blah, blah. Some people look at range bar charts. Some people look at cumulative volume charts. And I'm here to tell you that doesn't really matter. Honestly, you can look at whatever the hell you want because that's not the point of what we're trying to do in terms of market movement. I don't want to sit here and look at price action movement based on specific different time frames or specific charts. It doesn't matter too much. The only thing is the generalization of the trends, and I'll explain exactly why. So for instance, here on the S&P, you can see this is a 1500 volume per bar chart, right? You can see how the price action, the trend moves, right? We're going lower lows, lower highs. If you take a look at the range bar chart, which is this one here on the S&P, and we compare the two, it's the same thing, right? You're seeing the same movement, lower lows, lower highs continuously. You have the same trend. If you look at a 5-minute chart, for instance, you're going to see the same concept. So that's not necessarily what's important right now. We can use this chart. We can change it into a 5-minute. It's not going to give us anything different from a price action perspective, regardless of what kind of chart we're looking at. So I'm just going to leave it. This is a 3-range chart, right? Use a volume bar chart, whatever the hell you want. The first thing that we have to understand is markets move in trends, right? Markets are fractal, they move in trends, they tend to trend in 2 high-level trend moves, right? Now, before you say, oh, I thought there was 3, just give me a second. So there's the compressive move, which is a range that we see, for instance, here on the S&P on the futures, where no new information enters the market. We trade in a balanced area, right? The buyers and sellers are generally equal in these ranges. And then the second general move is an expansion, right, which happens outside of these ranges. So these expansions are up or down, where new information causes buyers and sellers to get imbalanced and they dictate direction. So the market generally contracts for about 70 to 80% of the time, meaning the majority of the time we're trading in ranges, right? And then that 20 to 30% of the time, there's going to be some kind of expansion outside of that range. And this is where a lot of traders get kind of frazzled, right? Understanding, oh, okay, when is it actually going to trend? When is it actually going to range? That's something that we'll talk about. within this market movement, there are three different ways to look at the market, right, around the compressions and expansions, which, of course, we have a bearish trend, which you see here on the screen. Bearish trends are very basically identified by lower lows and lower highs. So you have a high here. Okay, you make a new low past these lows. Okay, you have a new high here, which is a lower high. You make a new low, right? So on and so forth. The bullish move generally is a complete opposite. You make higher highs and higher lows, right? And you continue that movement, something like this, right? Higher highs, higher lows continued. And then the range or the balance is equal highs, equal lows, similar to what we had yesterday during the trading session. Now, the goal here is to understand how these structural moves are expected to continue or to break, which is just seeing where the market no longer prints higher highs and higher lows, or lower lows and lower highs, or it doesn't keep printing equal highs and equal lows. So let's take a look at this from just a very easy drawing perspective, for instance. We could even add some time frames to this, right? So we can take a look at this, let's say 5-minute chart here on the S&P on TradingView, to tell you that it doesn't really matter what kind of chart you're actually using. So for instance, we have this general larger range that shaped up over the past several days, right? We have equal highs, equal lows, equal highs, equal lows. The easiest way to understand that a range actually breaks is this stops happening and you get an expansion outside of it, right? Now, once we start talking a little more about auction theory and the idea of balances, we're going to understand that ranges, just like this one, you have to be very careful about them, because you want to see a very, very strong expansion to actually create the continued move outside of this range. Typically, right, if we have an opening print above or below these ranges, that's usually when that break happens. Because a lot of the time, everyone looks at this range and they think, oh, okay, we've actually broken to the downside, for instance. And everyone's going to try to short the pullback into that range, and what happens is you move back inside that range because that's where price is more at home. So these larger expansions, a general rule of thumb on the S&P, if you get a move that's like 10 plus points outside of an area that happens to be a range, right, then you can look at it from the perspective that there is going to be a continuation of the market movement in that direction. On the NASDAQ, generally a rule of thumb I look at is like 50 plus points as a price action perspective. So when I'm looking at this, right, that's how the range breaks. When we're looking at downside moves, for instance, you have this bearish move over here, right? A bearish move is denoted by lower lows and lower highs. So the easiest way to break this bearish trend is to stop printing this. Now, the main factor here is going to be the lower high, right? Lower lows, you can have theoretically, right, equal lower lows. Ideally, they're going to be continued lower lows. If there's a higher low, that's what starts the shift. So for instance, if you have this move and you create a low here, then you pull back up and you create a slightly higher low, that's what starts the break of the trend. But what really breaks the trend is when you cease to create, right, lower highs, and you actually start creating higher highs in this circumstance, tagged with higher lows, right? That's what breaks the trend. When you're looking at a bullish move, right, from a bullish perspective, it's the same thing, right? You have higher highs and higher lows that denote it. For instance, you have something like this. And to really break this down, it's not about having just incremental lower highs. This is a starting point. But once you actually start breaking the higher lows perspective, that's when things start shaping up. But to kind of get a better understanding of all this price movement, I'm going to be using volume more so, and we're going to be using the volume profile. I'm not one to necessarily look at price action from the perspective of trying to, I guess, qualify the entry of a trade, more so qualify and help with the directionality. For instance, if I'm looking at an area and we have, let's say this is going to be a major resistance because it's a key level. We'll take a look at that in just a minute, but let's say this is a major resistance. Realistically, if we can't continuously print lower lows from this area starts to break down in terms of strength, right? Meaning that I don't want to constantly try to sell into this area if we can't make significant lower lows to continue the momentum of the trend. That's where a lot of things actually start breaking down. So this is the idea of strong-handed traders, right? What are strong-handed traders first and foremost? This is the whole premise of what we're looking for. Strong-handed traders, they're the ones that create these moves, whether it's a range, whether it's a downside move. They're institutional traders, right? They're traders with large size, hedge funds, right? Market makers, stuff like that. They're generally considered institutional traders that put large amounts of contracts to work in the market that create directional swings, right? They create balances in the market, right? They create the ranges, they create the expansions, they create the head fakes of the expansions. They do it all, and what we're trying to do is locate where they're at. And if I'm looking at this current price action setup, we can get a general understanding. For instance, when we have a trend, when we have a range like this, right, the general strong-handed traders, what they're trying to do is keep prices in balance until at one point you get a significant push lower and those strong-handed traders are going to take things to the downside. But I don't want to sit here and kind of guesstimate where these areas are or where the strong-handed traders might be on pullbacks. Instead, I can use a volume profile and just understand where they are at a very quick glance. So these strong-handed market participants, they're going to dictate price movements, and we're going to focus on a lot of the understanding of how they move the markets, right? NASDAQ, S&P predominantly, with the use of a volume profile, with the use of auction market theory, because it just makes it a lot simpler, right? The next part that we have to understand is stop zones, right? Stop zones in terms of market movement are very important. Now, stop zones, everyone looks at this as a market maker trick to just fleece out retail. That's not the case. They don't give a shit about where your stops are if you're trading a few lots, right? Even a few minis. They don't care at all, right? Especially if you're trading prop, right? So it's not a factor. But stop hunts are a real thing, right? A lot of people call them liquidity creation, right? When you create liquidity through prior lows and reverse back into an area, which is generally a mean reversion, right, if you're inside of a balance or outside of a balance. But stop zones, right, liquidity creation is a huge area that frustrates traders. It head fakes under lows, right? You could be looking at this range and thinking, oh, I want to get long over here at 57. My stop is just under the lows. Bam, stopped, and then it reverses. Very frustrating. And then it goes in the direction. So tiresome and frustrating. We can understand this through auction theory a lot better, but there are a few different things to break down in terms of stop zones, right? In terms of market structure and strong-handed market participants. We're going to talk about major swing highs and swing lows. We're going to talk about cascading stops as well and one-time framing. That's the general basis of where these strong-handed market participants are looking to place their stops. So generally what happens in terms of a stop zone or a liquidity grab or a liquidity creation or a stop hunt is that these stops get triggered, right? And then prices tend to reverse after those stops are hit. Now, they also create a turning point in market structure. So first and foremost, let's talk about major swing highs and swing lows. Generally speaking, right, you can look at this from a higher time frame or something larger, right, some kind of larger time frame where you're looking at maybe like a 15-minute or like a 4-hour, and you're looking at where those highs and lows are. Predominantly, you're going to find stop hunt zones through those highs and lows, like for instance, above these areas, for instance, like below some of these areas, below some of these areas, where you're going to be looking for a move that rejects that price, right, comes back within, and then starts turning over. Realistically, it's good to understand where these areas are, just in case you're trying to position yourself in that direction. For instance, if we have a major swing high here and we're looking at prices to continue to the downside move, we've had this most recent range. Realistically, I want to place my stops significantly above that area, or I want to wait to see if price actually head fake, grab the stops, and then start rolling over. Right, so I do want to understand where major swing highs and swing lows can be from individual sessions to see if they want to grab those stops. For instance, this is a great example over here, right? They run stops through this area, and what happens when everyone now decides, oh, we want to get long because we're breaking through tops. What happens is prices actually revert back into the direction of the overall move. So stop hunts, generally, when we start looking at auction market theory, they happen at areas of low volume. So it's a lot easier than trying to decipher if the low is a good low or if the high is a good high. Instead, we can take a look at it and understand if this is a distribution and this area is low volume, this area is very easily manipulated by strong yen and market participants. So if prices manage to go into this area, right, there's going to be a lot of stops that are hidden into the low volume because prices want to stay within a balance, for instance. So it's the same thing within a range. So if we are in a range and there's like nothing above, well, it's going to be very easy to take those stops out, but it's also going to be as easy to continue the directional momentum of the range that's being created, right? Another factor that we have to understand is cascading stops. Cascading stops are directional stops that large traders try to place so that you have a strong turning point in the market if those stops get hit realistically. So if we're taking a look at this, let's say for some reason, right, you have a lot of institutional selling that happens here, right? They decided that's an area, okay, let's start selling. Well, they're going to sell into this spot, into these highs, in relation to cascading stops. And let's say this block represents the stop size, right? They sell into this area and they say, okay, we're going to put our stops above this area. Now, when we create new lows, realistically, let's say these lows, and we start to create these highs over here that keep holding out, what they're going to do is add into positions, and this stop block over here starts to gradually gain in size, right? So right now, with this larger expansion, these guys could be waiting to see maybe a pullback, maybe back into this area somewhere. And let's say they start triggering, right? And they say, okay, well, back into this area, now their stop, the size of their stop is represented by, or the amount of stops accumulated is represented by this massive block over here. So the idea is as prices continue going down, 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 they're going to position themselves continuously shorting, and increasing the size that they're using, as well as increasing the size of the stops that are being used. So once these stops get triggered, what happens is that's when you're going to get a large reversal in price. So it's the same thing as looking at this and thinking, okay, you have a range over here, right? Maybe there's a distribution range over here. How are the stops going to realistically get hit? Well, those stops get hit once we start moving back into prior ranges, prior balances, right? Once we start moving back above those areas, it changes the overall structure of the market and those stops start getting hit. And then the final piece of information in terms of stops to understand where they might be positioned is going to be something that we call one-time framing. So let's break that down. So one-time framing is more of a price action aspect, right? I would say that most things that I'm talking about here are more price action, but they're very effective once you start combining them with auction market theory. So one-time framing, it happens when each new bar fails to take out the previous bar's opposite extreme. So for instance, if we're looking at a bigger picture, right, maybe even a 30-minute chart, if we're looking at what's going on and we're seeing that the downside move is shaping up, for instance, this bar over here, right, the next bar can't take out the extreme top of that bar, right? So that's telling us that it can't close above it. That's telling us that there's strength on the sell side. The next green bar over here can't be fully taken out by the red bar, right? So on and so forth, so on and so forth. They just can't be taken out, which is telling us that there is some kind of continuation to that downside move. Now, obviously, these things more so with auction market theory make a lot more sense because, for instance, over here, right, if we take out this prior top from the prior bar, right, the idea is to close above it. We don't. So it does continue. But from an auction perspective, if we look at this and say, okay, this is a balanced top actually, so there's no expectation to take out that bar. That's an area where we're looking for that sell side pressure. So generally, we're looking for reversals from these moves that can happen from this one-time frame because the expectation is that stops get ran once prices close, right, certain time frames above those extreme highs or lows. So when we have a trending move like this, realistically, if we can close above this developing candle right now, the next candle or this candle right here, that's where we start looking at the shift because the stops are going to get hunted and we're going to see that expectation to turn the tide. So from a price action perspective, that's the general setup and breakdown for stops and trending moves. But once we start adding auction market theory into the mix, we start getting a better idea of how all of this comes together. Because again, I can look at this chart and there's, right, multiple candles here. There's a lot of information. I can look at it from candle to candle. I can look at it from trend to trend. I can just squint my eyes and say there's a general range shaping up here. Or I can understand what's going on from a volume perspective so that I don't really have to look at these candles too much. I just have to understand if we're making lower lows, lower highs, higher lows, higher highs, right? That's the only thing that I want to concern myself with so that I can continuously keep selling a level or keep buying a level, whatever the case is, and try to understand where those reversals are. So since markets compress most of the time, right? They move in ranges. That means we want to use that information to dictate how strong-handed market participants actually are entering and exiting the market. That's the premise of auction market theory. So we can get rid of this chart just for now. But the premise of auction market theory is that the market, it moves inside of a balance, inside of a range about 70 to 80% of the time, right? So that means that strong-handed market participants are going to try to create this over and over and over again. Meaning even if we move into new all-time highs, there's going to be some kind of creation of a range or the development of a range. So this is auction market theory, right? It's the market movement philosophy that combines a volume and price movement to get a better understanding of where these large market participants are. So think of it this way, right? Markets are moving in a range. Right, this is a range, and what happens in this range is that there's no new information, meaning that buyers and sellers are generally equal, right? They're overall equal. You have sellers that are trying to hold the tops, you have buyers that are trying to hold the bottoms, and these are going to be the strong-handed market participants that try to hold the extremes of this range to keep things, right, in that same spot. So what happens when new information actually enters the market? What the expansion outside to the downside or the upside is created by the strong-headed market participants taking control of that trend move. In this case, the sellers are going to outweigh the buyers, and you're going to see that new information seeping through the market that creates this expansion about 20 to 30% of the time. So this area is what we call fair value, right? Very large market participants have said, you know what, this is where we anticipate price holding out. This makes sense based on the current information. This is what the market's valued at. This is going to be the fair value, this balance. Anything outside is going to be considered unfair value. So the unfair value creates these expansions and is in search of prior balances, right, in the case of markets moving lower, or we're looking for the creation of developing balances as prices move higher and there might not be information there. So strong-handed market participants, they hold at the extremes of these ranges. So what we have in market movement is a constant cycle of a range being created, right? A balance or fair value being created. Some kind of new information enters, markets leave that area, and then there's usually a prior balance from a lower price into a low. And prices want to move into that area because this is what's considered fair value. New information comes in yet again. Strong-handed market participants get very active. They move into the next area. They continue their move. New information might enter again, like for instance CPI recently. And then they expand into new all-time highs, and from there they develop a new range, which is considered fair value. So this is how markets move, right? Markets move based on the understanding that fair value is constantly created and created and created, despite unfair value moves. So what we're trying to do is we're trying to understand where the fair value is and where value starts to get unfair. So the market participants, strong-handed market participants inside of balances, we have a good understanding of them wanting to hold within the balance, meaning that we can trade the extremes of that balance. Once we get an expansion outside, right, which ideally is confirmed, again, on the S&P for approximately a 10-point move, on the NASDAQ approximately a 50-point move throughout the day. Otherwise, if we get a close, right, and a reopen on the RTH outside of these balances, that's generally what confirms this kind of trend expansion. So today, if we reopened above or below a general balance, that means that we're going to expect the expansion to continue in that direction. So when we're accepting outside of those areas, right, we want to follow the trend. There's also instances that we have to be aware of that those trends can get faked out, because if you have a move, right, let's say this is a balance, And outside of that balance, there's very thin volume on either side. There's unfair value on either side. Realistically, the expansion outside of a balance needs to be very, very big, or it needs to have a close above that area. Otherwise, if it's not very big, if it's small, when you're into a low volume area like this, it's very easy for prices to come back inside of that balance, because this is where the majority of volume is. That's where price feels at home. Everyone's going to try and buy into this area, right, on the pullback, on this little expansion. They're going to get their stops ran. This is going to mean revert, and we're going to pull back into that area. But, right, when we have something that's different, when we have an expansive move that's trying to hunt a prior balance. So for instance, if prices are coming in from above and they get a cleaner expansion back within the balance, what happens is that prices find their home and they generally tend to stay to continue the trend of that move. So with auction market theory, we're going to continue the understanding of market movement with price action and trend movement to identify more so directionality in the markets in the second lesson. Because again, right, I don't want to make this 30 minutes long. It probably already is 30 minutes long, trying to explain what's going on with the movement. But before I leave you with that, the idea here is, right, we can take a look at how this shapes up. So on the S&P, remember, what we're trying to do is we're trying to identify balances. So even from a price action perspective from today's session, we can see that there's a general range that's being shaped up on the S&P. Now, we can double down on that by saying, okay, there's a pretty obvious balance that's being created over here. This is the volume profile. This is what we're going to be learning next time. There's a pretty obvious balance that's being created over here, right? Fair enough. So as long as we stay within it, prices want to hold the tops and hold the bottoms. But the second we start expanding aggressively, what happens from that perspective? We're looking to continue to sell rallies into the pullbacks into those areas, right? When we move into a new balance, we're trying to do the same thing to get that kind of continuation to the downside. The trend is going to take place and the expansion is going to take place. So this is what we have here, right? You have a move under the balance, right? You pull back into that balance and we sell the rally, the lower high. You move into a new balance to the downside, what happens, right? We're trying to sell the pullback, sell the continuation, and we'll go from there. So the next video, we're going to be breaking this further down with volume profiles and auction market theory to get our heads wrapped around everything to do with market movement. So we're going to be doing an introduction on volume profiles, and then we're going to dive right into it. So I'll see you guys in the next video. And remember, we're going to be recording the beefed up futures course October 2025. So if you want to get a live viewing and a live seat, you can go check out the futures course. The link is down in the bio, and there is a discount, right, waiting for you. So I'll see you guys there. I'll see you at TRADEPRO Academy, and let's do this again.